Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of UK rate strategy, and I'm joined today by our global market specialists, Giles Gale and Nevruzi.
Okay, Imogen, you are up first this week. So the big news, I suppose, was that you hit your target on 10-year gilts. So the next question, I suppose, is what next?
Yes, well, avid listeners or readers of our research will know that we entered the year with a 4.3% 10-year gilt target. We then revised it down to 3.75, and having hit that this week, we've now thrown in the towel and revised it back up to 4.3%, if you like. I think, the drivers of why we revised it down from 4.3 to 3.75 were that we had a rapid repricing, I suppose, of inflation expectations with the fall in natural gas prices. We had a bit of a reassessment of which way the risks was tilted on the supply outlook, which we can go on to talk about. But it feels to me like the pendulum, if you like, on both of those factors has now shifted too far in the other direction. And so all the reasons why we entered the year being, initially bearish, and that we thought that inflation would still be slow to come down, that the bank would still be hiking rates and keep them on hold, not be cutting rates at the end of this year, and that net supply is going to be huge, and there's no real offsetting demand to take down all that additional supply. All of those things, I think, should matter again for gilts and should be pushing again in a bearish direction. So we're back to 4.3 on 10-year gilts, which is, I suppose, about a 40-ish basis point sell-off from where we are now. It's a little bit higher, 4.3 is, than where our kind of fair value model suggests that 10-year gilts should be, which is closer to 4%, really. But actually, I think, in this kind of bearish fixed income environment with momentum seemingly really all pushing in one direction right now, an overshoot versus where we see fair value in the model is probably more likely than an undershoot. But also because the model itself is calibrated on, historic yield levels, which have been in very different net supply regimes. And so it's possible that when calibrating how we look forward to the increase in supply and the risks of supply saturation, actually the model is underestimating what the impact on gilt yields could be, and with this kind of deluge of supply that's coming and lack of demand. And therefore, I'm kind of comfortable having a slightly higher gilt target than our fair value model has implied for the last couple of weeks.
Okay, very clear. So I guess you mentioned the remit there, and I suppose that is the next big event for gilts, really. So perhaps you could just talk a little bit about what your early expectations are on that.
Yeah, I think this remit's an interesting one because there's a lot of question marks around the overall gilt supply number. Well, I suppose there's always question marks around it, but it feels like there's a lot of moving parts this time around. And that's what I was really alluding to earlier when I said it feels like expectations have swung far in the other direction for a number of reasons. Firstly, you've had lower energy prices, which to a certain degree lower the kind of pull on government finances, particularly from the cost of the EPG. You've also had this narrative that we've spoken about before on the podcast, that there's the opportunity for the government to not lower their overall funding needs, but diversify these sources of funding. So perhaps get a little bit more via bills, a little bit more via retail, NS&I, the national savings and investment products that they have. And you've also had better than expected public finance data, which implies some undershoot on this year's borrowing numbers, which obviously puts them in a better position for the year ahead. So market expectations, I think, have swung quite far to now expecting, downside on that overall number, such that I think the risks are now skewed to the upside, because I think there's a limit really to how much they can actually do via bills and how much they can raise via NS&I, and really just how much they will save via lower energy costs. And then you have the added complication that we're obviously heading into pre-election year or years ahead, which means that any fiscal headroom that I think that they do have from an undershoot in borrowing in this fiscal year will ultimately just get recycled into kind of fiscal giveaways and vote winning measures in the months ahead. The question mark really is around when those vote winning measures are delivered, and whether any of this is announced in March in the next couple of weeks, or actually delayed to the autumn statement when we'll be a little bit closer to that kind of campaigning period for the election. So I think there is a risk that on that basis, perhaps the gilt number that's announced in the next couple of weeks looks kind of artificially lower, if you like, and that actually ultimately masks how high issuance is going to be in the autumn or perhaps even next spring when these kind of fiscal giveaways are announced. But I do think that risks have swung, or that expectations have swung so far in expecting, downside risks to the number, that the risks are really skewed to the upside there. In terms of split, though, I think there's probably a bit more of a consensus on what the kind of maturity of the issuance is going to look like. Clearly, there's a bit of consensus that they'll do a bit more via bills. And I think they will also do proportionally a lot less via longs and linkers, which means that this will weigh much more heavily on the shorts and mediums buckets. We're expecting in kind of sterling billion terms, the amount of longs and linkers to be the same. But obviously, as a proportion of a much higher number, that means that their weighting, if you like, in the maturity split will be much reduced.
And I guess just to round it all off then, we can't really not talk about the front end in the Bank of England. So I think that we got to pricing something like 4.8% as a peak rate for the Bank of England. It seems like an awful lot to me.
Yeah, too. I think I said it sounded like an awful lot last week, and we were at least about 10 basis points lower. So it definitely seems like an awful lot this week. I think we've been saying for a while that the bank really only needs to do one more 25 basis point hike this year, perhaps two. That's the kind of upside risk scenario. But beyond that, further hikes, I think, are unlikely. And that's not to say that the Bank of England might not be forced to hike again in this cycle, but just in 2023, I think they're unlikely to hike again beyond 4.5%, and that's in the risk case scenario. What it will be that forces their hand to hike further will be to do with the tightness in the labour market and the persistence of wage inflation. And I don't think they'll have enough clarity on that kind of this side of Christmas to be able to assess that they need to hike more than they already have, particularly when you consider the lag transmission mechanism of monetary policy, especially here in the UK, given the structure of the mortgage market, the fact that most mortgages are fixed, for 2, 3, 5 year periods. It means that there's a very long lag between the Bank of England hiking rates and those rate hikes actually being felt by the real economy. Their own data suggests that of the 300 plus basis points of tightening that they've done since December 21, only about a quarter of that has actually kind of fed through to the real economy via higher interest rates, because there's still a huge proportion of fixed mortgages that haven't refixed at higher rates. So because of this lag transmission mechanism, it means that tightening will still be being delivered to the real economy well after the Bank of England stop hiking rates, if they stop in March or if they stop in May, which means that I don't think that they will need to kind of over-deliver on that this year. Bailey's comments this morning, we're recording this on Wednesday, Governor Bailey's comments were quite dovish, I felt like. He sort of reiterated the message from the February meeting, was that in their central scenario, they didn't really see the need to raise rates much further than here, if at all. And it would really depend on how the data evolved between the kind of February, March and May meetings. And actually, with regard to the latest data, and it's the strength in the data that's been pushing the market to expecting, a significantly higher peak over the last couple of weeks. But actually, in his view, the data really was broadly in line with their central scenario. So I don't think that the governor was really endorsing a peak in rates anywhere close to 4.8%, to be honest with you. So we had been looking for kind of August, December steepness as the market priced out the cuts in 2023, which it has done. And now I think better risk reward is probably just being in kind of outright receivers of September, or perhaps a little bit later when that peak is now being priced in. Okay, that's enough from me. Let's think about Europe then, because although we hit our gilt target this week, we're also really not very far from hitting our Bund target, which has been 275 for a long time now, Giles. What's your view on where that might go next if and when we do hit 275?
Okay, I mean, I guess the answer is higher at this point. No, I don't think that there's anything that screams out that we ought to be calling for a turn in the momentum. In particular, the more aggressive ECB pricing that we have, which I mean, it is substantially more aggressive than just a few weeks ago, and especially within that, the steeper money market curve. So now we had this peak that was sort of around September, and then rate normalization thereafter, and we've actually seen quite a dramatic bearish steepening in the money markets curve. And that would normally be associated with higher rates all the way along the curve, which of course we've already seen. But no, just as a rough guess, because I actually haven't had the time to run the numbers through all models and so on yet, I would think that probably adds around 50 basis points to that. And no, I should just emphasize, I don't really feel like any of the key structural sort of sectoral stories have changed very much. I mean, we often try and break it down and just think, has anything changed for foreigners, for example? The Japanese, Americans, are they going to be looking at fixed income and thinking that's a lot more attractive? Well, no, not particularly. Their home markets look pretty good as well, I would say. Their banks, again, no, not especially either. I think that the widening that we've seen in asset swap levels as well sort of points in that direction. So I don't really see any change there. So the only thing kind of pushing in the other direction is just that basically I don't particularly agree with front-end pricing in Europe either. It has, it does seem like that's got quite extended. So I'll have to sort of put in some assumptions that are a little bit more in line with what we actually think and see what that tells us about it. The short answer to your question is I will be almost certainly, I think, revising that target higher in the short term.
I guess thinking about the front end then, one thing that's driven the front end higher this week in Europe has been the inflation data. We're recording this on Wednesday, so we don't have the full Euro area number yet, but we have had some national prints. What's the key message coming out of that, and how do you expect, or how important? I guess I don't want to ask what you expect for the number tomorrow, because it's going to be proved wrong or right very quickly on this pod. But how much do you expect that print to matter for the ECB going forwards?
I don't mind telling people early what I think. I mean, but obviously the inflation numbers were a large part of the reason. Well, they were the reason why we sold off this week. And overall, we've had more inflationary sort of reflationary data over the last month or so. Actually, now that has been really what's been driving the market. So, all of this matters. But as you say, we'll know what the actual European figure is by the time anyone actually listens to this. But so far the big countries have been on the high side, and they're probably suggesting about sort of 8.3 or 8.4% for the year-on-year figure for February for the euro area, which compared to expectations before this week of about 8.3 doesn't necessarily seem too bad, but nonetheless it's not the downward momentum that I think that the bond market, particularly at this stage with lots of supply coming in, that the bond market really would have wanted to have seen. It is, I think, important just to notice that we are down. Well, so if that's confirmed, 8.3 or 8.4%, let's say, that would be another fall compared to January, because the January number was 8.6%. So that is at least in the right direction. And just looking at the inflation-linked markets anyway, they have 6.9% year-on-year for March. It's really from March and April that the disinflation really starts to accelerate, because that's with the base effect. So those high inflation figures that came in early last year start to wash out of those annual comparisons. That would bring the Q1 overall average down to around 8%, which would still be well below what the ECB had in their December forecast. They were forecasting 9.1% for Q1. So, this isn't necessarily terrible. On the other hand, core inflation looks like it might pick up. Again, we will know by the time you listen, but it looks like that might be 5.4 or 5.5%, which is definitely not the right trajectory, and really quite alarming levels. And I think that is something which is a focus for markets. In addition to that, food inflation looks like it's going to be unpleasant until the second quarter at least, across the zone really. But yeah, just coming back to very quickly on the core question, because markets are quite fixated on the ECB's need to see all the indicators kind of heading down and corroborating the disinflation. And I'd just like to highlight that there's a bit of discussion about that Philip Lane's speech, or not speech, his interview from Tuesday this week, where he talks about underlying inflation, and to an extent, underlying inflation means you strip out the volatile components, food and energy, and so on. But he nuances a little bit by saying it's not as simple as just core. You do have to take into account the fact that energy prices influence the trajectory of everything at this point. So I think we'll just leave it at that. I mean, we're coming up to an important forecast round, as everybody knows, and it's not just going to be this data which feeds into that.
Okay, lots to watch out for that. Sticking loosely with the theme of inflation, I suppose, we updated our Fed call at the end of last week following the PCE data. So perhaps you can give us a rundown of what we're expecting now and the drivers behind that change in the view.
Yeah, so last Friday we got the core PCEs, the personal consumption, consumer expenditure numbers, which came even stronger than what we had penciled in. And I should remind that last time around when we were talking about how inflation would spill into the Fed's preferred gauge, the core PCE, we expected the strength from services side and the CPI to spill into PCE, but not so much the weaknesses. That's what happened, but even more so. So if you look at metrics that Chair Powell has pointed in the past, such as core services, ex housing, I mean, those are still marching on at a very, very high speed, and the Fed will simply be unable to ignore, I guess, not necessarily a strong pickup, but the lack of deceleration in those areas, which are still on track to be about over 5% on an annualized basis, and require immediate action. So our updated Fed call is for a 50 basis point hike at the next March meeting, which is pretty out of consensus at this point. Markets are pricing for about a full 25 and another 20% for a 50 chance for 50. And then we see two more 25 basis point hikes at the two meetings afterwards, so in May and in June, which means that the terminal rate would come to 5.5 to 5.75%. Now, the March call is, I should point out, not really a extremely high conviction. So we're not necessarily banging on the table saying, well, the Fed will 100% follow through with a 50 basis point hike, as Kevin Cummins, our economist, put it. But he sees it more around 60%. So more likely than not that they might step it up, as the data just gives them enough cover. There's different ways to look at it. Does the data give them a cover? Yeah, inflation was strong, unemployment was very strong, and we might get validation with the next set of data before the Fed meeting. It's definitely something that we think is likely. It would most definitely make the Fed's communication style a little bit more. Well, it would be a little bit challenging given the Fed's communication style, which is trying to be as predictable and as open to markets. Let markets price in a very clear message from the Fed. And if we do something like a 50 basis point, 25, 50, 25, that will certainly be a little bit more difficult. But there is enough cover with the data to point out and be, well, we had unemployment is a record low. We're adding jobs at extremely fast speed. Inflation is just not slowing down as much as we wanted to. We have to kind of do more. So that was the basis of our update, and we'll see. Next thing is for Chair Powell on the March 7th. He will have his semi-annual Humphrey Hawkins testimony in front of Congress, where he will likely touch upon these issues. We don't think he will commit to anything like a 50 basis point hike, and unfortunately, the unemployment and the inflation data comes before the Fed meeting, but during the blackout period where Fed officials are really not supposed to comment on monetary policy. So we're going to be in this limbo period where markets will likely be very volatile and ping pong between 50 and 25, depending on the strength of the data.
Very volatile. That doesn't sound like these.
That's a first, I guess.
Okay. So how does that leave your views then? I think last week we were talking about how you like being long the front end because obviously for our prior Fed call, it felt like markets are pricing in too much. Do you still like those kind of trades, or are you thinking about something else now?
Yeah, we'll like it. And when we were talking about the front end, it was not very much so the 1 or 2 year part, but more so the 3-year sector, as we are of the view that it will be very hard to price out the entirety of the rate cuts in the curve. And so if you look at forwards such as December 23, December 25 forward, so like I'm referring to SOFR futures in this case, you can see that the amount of cuts priced in haven't really decreased. If anything, that inversion has continued to get more and more negative. Of course, the overall level of yields was lifted, so the whole curve moved upwards alongside. But we think it will be, we don't think it will be easy or possible at all for that higher from longer to materialize anything past 2024. So once you stretch out, once you extend duration, things like 3 years, 4 years, now you're kind of in the purview of, well, a recession is likely, Fed cuts are likely, just a question of how much. So we still like kind of the 3 to 5 year area. We like 530 steepeners, especially now that that curve has inverted very, very sharply, kind of pushing like lows at negative 28 basis points as I walked into this room. Those are pretty, even tactically, pretty attractive levels. But when we talked about adding to 3 years, we were discussing adding it like half risk, see if there's a further backup in yields as we got another shock or Fed shock, which kind of happened. We didn't quite hit our target, but we were pretty close to adding more in threes at like 460, where we think would be a sufficiently attractive level to just fade with more conviction. Other than that, something else that we have been discussing this week, and we'll have a much longer write-up on, have been break-even inflation expectations. So I think with our new Fed call and what we expect from the data, what we haven't seen is a fall in inflation expectations. So when I talk about break-even, it's the difference between nominal and real yields, which is a rough measure of what market sees as inflation compensation should be over a certain period of time. At the 5 year point, they're still lingering around 2.3%, which I think is still fairly high given the combination, the combination that you might get from a hawkish Fed and a subsequently weaker data. So if we have this type of risk-off trading due to, well, the Fed says we have to do a lot more, say the dots get adjusted to 575, and by dots is the next set of forecasts we're going to get from the Federal Reserve at the March meeting. Say they get adjusted to 575 range, and then you see a slowdown in jobs that I believe that would sharply impact things like 5 year break-evens. And I point out 5 year because relative to their historical performance, they are the ones that look a little elevated to me. And we think markets still offer an opportunity to get the downside in those, as they haven't reacted similarly with real yields and nominals moving up at the same time. So we do see downside risks for inflation expectations, not very much on the front end, but more so areas like the 5 to 10 year are the sweet spot for us.
Okay, great. Lots to watch out for on the calendar. All right. Thanks, everyone. I think that's probably enough for today. We'll wrap it up there. Thank you both for joining me. Just a reminder to our listeners, if you like today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.